Welcome to this episode of Phillip Futures Market Watch. My name is Jonathan Chan and I'm an investment analyst with Phillip Futures. And today I'll discuss about the crude oil outlook for the fourth quarter of 2016. Here's the overview of this episode. First, we will analyze the crude oil prices through different measures, after which we shall explore the fundamentals driving these changes and then use this information to come up with a price forecast in my last section. I shall now start with a crude oil price analysis. Brent started the year at an all-time low of $28 per barrel, after which it spent the next 2 quarters recovering back to $50. It then spent quarter 3 being range-bound between $40 and $50. Moving on to daily volatility analysis, crude oil can be seen to be very volatile. Referring to my diagram, the daily volatility is seen to be normally distributed around 0. About 70% of the time, daily volatility ranges from negative 2.8% to positive 2.6%. While at 95% of the time, the daily volatility range will expand from negative 5.5% to positive 5.3%. This high volatility combined with its high liquidity presents good trading opportunities. Using forward curve analysis, we see that the oil market contango has steepened around the 4-year tenor as compared to the beginning of this year. Based on finance theory, this contango effect is where the spot rate is depressed due to an oversupply and hence is lower than its forward rate. Thus, an upward sloping forward curve is formed as seen in this diagram. This oversupply hypothesis will be further expounded in my next section as I link this with oil fundamentals. Now I shall proceed to talk about the updates on the oil fundamentals. Moving on to the production side, oil production continues to remain high. Despite all this talk of an output freeze by OPEC members, OPEC global production has increased by 6% in absolute terms and 1.5 percentage points in market share of global production over the last 2 years. This is significant as OPEC currently accounts for about 40% of global oil production. I'm not very optimistic about the ongoing output freeze negotiations in Algeria between OPEC and Russia this week, as even if there is indeed an agreement reached, it might not actually be carried out by its members. On to inventories, as oil prices are relatively higher now than compared to the beginning of this year, US oil inventory has been massively stockpiled throughout the first half of this year, are now slowly released into the markets to earn higher revenue. My belief is that there is a price ceiling at around $50 as each time oil goes above that, there will be incentive for inventory owners to release their stockpile, and the US stockpile currently stands at above a massive 500 million barrels as can be seen in this chart. Moving on to speculative position as derived from the weekly commitment of traders data released by the US Commodity Futures Trading Commission, the gain in oil prices this year have been mainly driven by speculative pressure in the oil derivative market. This is illustrated in this chart where there is a strong positive correlation between net long managed money positions and crude oil prices. I strongly believe that this speculative inflow is caused by a combination of 2 global macro factors, which are, firstly, the generally loose global monetary policies that have inflated financial assets prices to historical highs, and secondly, that oil can be seen to be undervalued relative to the rest of these financial assets, as it was trading at 18% of historical high at the beginning of this year, to having risen to 31% of its historical high as of currently. This increase in speculation is also probably what drives the additional volatility in oil markets. Moving on to the US dollar factor, oil is generally negatively correlated with the US dollar as can be seen in our diagram. With a highly anticipated US Fed hike this December, given all other factors constant, this development is expected to put downward pressure on oil prices that are denominated in US dollar, so as to adjust for a rising US dollar. Finally, I shall conclude with my crude oil price forecast for the fourth quarter of 2016. I believe that oil prices will be kept below the $53 ceiling based on the following factors that I presented earlier. Here is a quick recap. Firstly, the expectation of a rising US dollar given the expectation of a December rate hike. Secondly, there is still massive inventory to clear. And lastly, it is my belief that OPEC and Russia might not be able to execute a production freeze. What I believe is keeping oil prices above the 40 US level is speculative pressure due to globally loose monetary policies and oil still being a relatively undervalued asset. However, should this speculative pressure wane, oil prices may break below the 40 US dollar support level. It is also because of this speculator-driven market that I believe that oil prices will continue to stay volatile throughout the fourth quarter. Moving on to our product offering, here are some of the crude oil futures products that we offer at Phillip Futures. Firstly is the CME WTI. Secondly is the ICE WTI. Thirdly, ICE Brent. Last but not least, the ICE Singapore Mini Brent, which is at a smaller 100-barrel contract, which is suitable for beginners. Do contact us at the following means if you are interested to find out more or to trade. We look forward to hearing from you. Okay, this marks the end of this episode's Phillip Futures Market Watch. Thank you for your time and we hope you'll join us again. Until next time, my name is Jonathan Chan and I'm an investment analyst at Phillip Futures. Goodbye.